Right now, as you are watching this, the S&P 500 just closed above 7,500 points for the first time in history. 24 record highs this year alone. The Dow's at an all-time high. The Nasdaq's at an all-time high. If you turned on financial news today, every single anchor would tell you this is one of the best times in a generation to be a young investor. I am going to make the opposite case. I think this is one of the worst entry points the market has handed young investors in 25 years. Not because a crash is guaranteed, not because you should panic and sell everything tomorrow, but because almost nobody is explaining what the market is booming actually means for someone who's 23, just opened a Roth IRA, and is about to start dollar cost averaging into index funds for the next 40 years. By the end of this video, you'll understand exactly why a booming stock market can be quietly bad news if you are young, what the data is actually telling us, and more importantly, what you should do about it, not theory, an actual playbook. And I want to say this up front because I know how this kind of video usually gets framed. This is not a "the crash is coming, buy gold and canned beans" video. I am not selling fear. I am not telling you to stop investing. I am telling you that the conditions you are starting in are genuinely different from the conditions the investors who taught you to just buy index funds started in. And if nobody explains that difference to you, you are going to make decisions based on a version of the market that does not currently exist. Let's get into it. Here's the sentence that should sound contradictory but isn't. The better the market has performed recently, the worse your expected future returns probably are. That sounds backwards. We are trained to think the market is up. That's good news. And in the short term, sure. If you already own stocks, record highs mean your portfolio is worth more today than it was yesterday. Congratulations. But if you are young, you are not primarily a person who owns stocks today. You are primarily a person who is going to be buying stocks for the next 3, 4, 5 decades. Your net worth in 20 years depends almost entirely on what you buy between now and then, not on what's already in your account. And that distinction changes everything about how you should feel about a record-breaking market. Think of it like grocery shopping. If you already have a fully stocked pantry and prices at the store go up, you don't really care, you are not buying right now. But if you are about to do 40 years of grocery shopping and prices just hit an all-time high on day one, that's not a celebration. That's a warning that you are about to pay more for the same basket of goods than the people who shopped last year, or the year before, or the decade before that. Stocks work the same way. The price you pay today determines the return you get tomorrow, and right now, you are being asked to pay more for $1 of corporate earnings than almost any point in the last 25 years. Let's actually look at what's happening because the headlines love the number that sounds exciting and skip the number that explains why it matters. The S&P 500 is up roughly 10% so far this year. That's on top of a 24% gain in 2023, a 23% gain in 2024, and a 16% gain last year. Stack those together and you get one of the strongest 3.5-year runs in market history. Genuinely incredible if you were already invested. But here is the number that matters more if you are just getting started. The market's forward price to earnings ratio is sitting around 23 times. The long-run historical average is closer to 18 times. That 5-point gap isn't trivia. It's the difference between paying a fair price for future earnings and paying a premium for them. Now zoom out further and look at something called the CAPE ratio, the cyclically adjusted price to earnings ratio. It smooths out short-term earnings noise by averaging 10 years of inflation-adjusted profits, which makes it a much better gauge of whether the market is actually expensive or just having a good earnings year. Right now, the CAPE ratio is sitting at around 42.5. To put that in perspective, the long-run average for that number is somewhere in the high teens. The only other time in American history it got close to where it is today was December 1999, the absolute peak of the dot-com bubble, right before the Nasdaq lost roughly 75% of its value, and the S&P 500 spent the next 13 years just trying to get back to even. I want to be careful here because I am not saying we are about to repeat 1999 beat for beat. Markets don't replay history on command, and there are real differences this time. The companies driving this rally are massively profitable, not pre-revenue.com's burning cash on Super Bowl ads, but the valuation math doesn't care about the differences in the story. Historically, when you bought the market at this kind of CAPE level, your returns over the following decade were dramatically below average, in some cases close to flat, after inflation. That's not opinion, that's just what happened the handful of other times in history valuations got this stretched. And to be clear about what that actually looked like in practice, someone who bought the S&P 500 right at that dot-com peak in early 2000 did not see their investment return to its starting value in price terms for roughly 7 years, and then promptly walked straight into the 2008 financial crisis, which took the index back down again. All told, an investor who bought at that exact peak was looking at something close to 13 years before they were reliably ahead of where they started. Compare that to someone who bought during the 2022 bear market. Prices recovered within about a year, and with the AI rally on top, that investor wasn't just back to even, they were up by more than 50% within a couple of years. Same asset class, wildly different experience. The only real difference was the valuation you walked in at. Let's make this concrete with actual dollars, because abstract ratios don't hit the same way real numbers do. Say you are 25 and you start putting $500 a month into an S&P 500 index fund. If the market returns its long-run historical average of around 9 to 10% a year going forward, after 30 years you'd have somewhere north of $900,000. Genuinely life-changing. But if the next decade looks more like what historically followed CAPE readings in this range, say returns closer to 3 or 4% annually for 10 years before reverting back toward the long-run average, that same $500 a month ends up tens of thousands of dollars behind where the average scenario would have put you. Even by year 30, the market doesn't have to crash to hurt you. It just has to be mediocre for a while, right when you are putting in your largest contributions relative to your account size. Here is something that almost never makes it into the stocks are booming headlines. This rally is not as broad as it looks. A handful of companies, Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla, sometimes called the Magnificent Seven, now make up roughly a third of the entire S&P 500's market value. A third out of 500 companies, 7 of them account for a third of the index. When you buy an S&P 500 index fund thinking I am diversified across 500 American businesses, what you are actually buying is a portfolio that's disproportionately a bet on AI infrastructure spending continuing to accelerate. If Nvidia's growth slows, if AI capital expenditure cools off even slightly, if guidance from 2 or 3 of these companies disappoints in a single earnings season, the index doesn't just dip, it can drop hard because the diversification you thought you had was thinner than the label suggested. This matters specifically for you as a young investor because most beginner advice, and most of it is good advice in general, boils down to just buy a low-cost S&P 500 index fund and don't think about it. That's still solid, foundational advice, but don't think about it is doing more work right now than it used to, because the thing you are not thinking about is more concentrated and more dependent on one narrative continuing to play out than at almost any point in the index's history. Okay, so valuations are stretched and the index is concentrated. Why does this specifically hit younger investors harder than someone who's 55 and already has a 7-figure portfolio? 2 reasons. One is math, one is psychology. The psychology one is honestly more dangerous. The math reason is what's called sequence of returns thinking, and I want to be precise about this because it gets oversimplified online. If you are investing consistently every month for the next 30 years, a rough patch early on isn't actually catastrophic. You'll keep buying at lower prices during the dip, which historically works out fine. Sometimes even better than if the market had just gone up in a straight line the whole time. Time and consistency are genuinely your biggest advantages, and nothing about elevated valuations changes that fact. The psychology reason is where it gets real. If you opened your first brokerage account in the last 2 or 3 years, every single market experience you've had is I put money in, it went up. You've never lived through a real drawdown as an investor. You've never watched your account drop 20% and had to decide in that moment whether to keep contributing or panic and pull everything into cash. That's the actual danger of a long booming run for a new investor, not the math, the conditioning. People who start investing during a strong bull market quietly build the assumption that this is just what investing feels like. Then the first real correction hits, and because they were never prepared for it, they sell at the bottom, lock in the loss, and often don't come back to investing for years. The market doesn't ruin young investors, their own untested reaction to a drawdown does. So the bad news in this video's title isn't really about a number going down. It's about the fact that a lot of people your age are about to take their first real test as an investor without ever having studied for it. I know what some of you are already thinking because it's the most common pushback to a video like this. People have been saying stocks are overvalued since the early 2010s, and the market just kept going up anyway. Anyone who sold in 2017 because valuations look stretched missed out on years of massive gains. So why should this time be any different? Fair point, and worth addressing directly instead of dodging it. Being overvalued and being about to crash are not the same statement. A market can stay expensive, get more expensive, and stay that way for years. Valuation tells you almost nothing about timing. People who tried to use high CAPE readings as a sell signal in 2014, 2017, or 2021 lost out on enormous gains. And that's a real, well-documented cost of trying to time a top based on valuation alone. I am not disputing that. What valuation actually predicts reasonably well isn't when the next drop happens. It's the range of returns you should expect over the following decade. Lower starting valuations have historically led to higher subsequent 10-year returns. And higher starting valuations like today's have historically led to lower ones. That relationship has held up across roughly a century of market history, even though it tells you nothing useful about next month or next year or sometimes even the next 5 years. So the lesson isn't sell now because it's expensive. The lesson is don't expect the next decade to look like the last 3 years just because valuation has been a bad short-term timing tool in the past. Those are two completely different conclusions, and conflating them is exactly how people end up either panic selling at the wrong moment or getting blindsided when the easy years quietly end. Before I get to the actual playbook, let me kill a few bad instincts, because I guarantee at least one of these is rattling around in your head right now. Don't try to time the top. I know it's tempting. Valuations are stretched. I will just wait for the dip and buy in cheaper. Professional fund managers with research teams and decades of experience fail at this consistently. You watching a YouTube video on your lunch break are not going to outtime the market. Pulling out now and waiting for the right moment has historically cost people far more in missed gains than it saved them in avoided losses. Don't stop contributing. The instinct when something feels expensive is to pause and wait. Do not. Consistent investing through both expensive and cheap periods is the entire point of dollar cost averaging. It's specifically designed to stop you from needing to guess whether today is a good entry point. And don't swing the other way either. Don't take this video as a reason to get more aggressive, pile into leverage ETFs, or YOLO into whatever's been pumping the hardest. Elevated valuations are a reason for more discipline, not less. So here is what you actually do with this information. First, recalibrate your expectations, not your contributions. The last 3 years gave you 20+% annual returns. That is not the baseline. The long-run historical average for the S&P 500 is closer to 9 or 10% a year. And starting from today's valuations, even that might be optimistic for the next decade. Keep contributing the same amount or more, just stop mentally budgeting your future life around 2023 level returns repeating forever. Second, actually diversify. Don't just assume you already are. If your entire portfolio is one S&P 500 index fund, you are more exposed to 7 tech companies than you probably realize. Consider layering in something like an equal weight S&P 500 fund, which gives every company in the index a roughly even slice instead of letting the giants dominate or adding international exposure. International developed and emerging markets have been historically cheaper relative to their own earnings than US stocks, and a weaker dollar environment has made that diversification even more relevant lately. You don't need to abandon US stocks. You need to stop being one earnings call away from a bad month. Third, increase your savings rate as your hedge. If expected market returns are lower from here, the simplest way to compensate isn't trying to find a clever investment, it's saving a higher percentage of your income. A 25-year-old who saves 20% of their income at modest returns will, in almost every scenario, end up wealthier than a 25-year-old who saves 10% and is hoping for the market to bail them out with exceptional returns. Your savings rate is the one variable you actually control. Valuations are not. Fourth, get your tax-advantaged accounts in order before anything fancy. If your employer offers a 401k match, that's an automatic guaranteed return on your money before the market does anything at all. Get the full match before you do anything else. After that, a Roth IRA, given decades of tax-free growth ahead of you, is usually the next move. None of this changes because valuations are high. If anything, tax-free compounding matters more when starting returns might be lower because you need every percentage point you can keep. Fifth, mentally rehearse the drawdown now. While it's hypothetical, decide today, on a calm Tuesday with no money on the line emotionally, what you will do when your portfolio drops 20 or 30%. Write it down if you have to. The answer should be I keep contributing on schedule. Not I will figure it out when it happens. People who decide their plan in advance are dramatically less likely to panic sell than people who improvise in the moment. Sixth, remember the asset you actually have that nobody else in this market has as much of: time. A 55-year-old looking at a CAPE ratio of 42.5 has a real reason to be nervous, because they may not have 30 years to ride out a slow decade. You do. Even in the historically bad scenario, buying at a .com level valuation and getting a rough decade. Investors who kept contributing eventually came out ahead simply because they had enough runway left to outlast the bad stretch. Time doesn't cancel out a bad starting valuation, but it gives you room to absorb it that older investors simply don't have. Here is the actual takeaway, and it's less dramatic than the title might have suggested. The stock market being at record highs doesn't mean you shouldn't invest. It doesn't mean a crash is imminent. It doesn't mean you've missed your shot. It means the free lunch of the last 3 years, where almost any strategy worked because almost everything went up, is probably over. What's left going forward is the harder, less exciting version of investing. Consistent contributions, real diversification, a savings rate you actually control, and the emotional discipline to not panic the first time the number on your screen goes red instead of green. That's genuinely less fun to talk about than stocks only go up. but it's the version of this advice that actually survives contact with a real market cycle, which statistically you are going to live through more than once in the next 40 years. Here is the honest way to think about your position. If you are in your 20s watching this, you are not unlucky, you are not too late, you haven't missed anything. You are simply starting your investing career at a moment that requires more discipline and more realistic expectations than the moment your older sibling or your parents or the finance influencer with the rented Lamborghini started at. That's it. That's the whole story. It's not a tragedy. It's a different set of starting conditions. And the people who do well from here won't be the ones who found some clever way around that fact. They will be the ones who accepted it, adjusted their plan accordingly, and just kept showing up every single month regardless of what the headline said. The market doesn't owe you the returns of the last 3 years. It never did. Plan accordingly. Alright, I will see you in the next one.